Welcome to our September Market Trends Report. Probably the biggest change this month is the drop in pending home sales. So is the market starting to cool off? Well, we talked about this last month, but let's look at the pending home sales going all the way back to 2012. We dipped down during the lockdown, come back up and pack a punch of activity and a bunch of home sales in the summer of last year. And then the drop, that's that little red bar. And you see that drop, well, still well ahead of where we've been historically, but off the highs of what we saw over the summer of last year and coming into the spring of this year. If we were to draw a line of what a healthy market looks like, this guideline gives you a perspective of a healthy market. It's still a really good market, but starts to put that drop in pending home sales a little bit into perspective. Now, context is really important. Just like we looked at existing home sales, we want to look at everything. We looked at the last 10 years of pending home sales, and we see this drop. It puts that into context for us a little bit. So let's go through and look at a couple of other things, and let's focus on the context of what's really happening in the market today here in the Front Range. Looking at Showing Time's monthly report, you see the two red bars there during the lockdown last year in May, March, and April. And then came back, packed a lot of business in during the summer. Then saw a tremendous amount of business as we started off this year as well. But we started to dip down. Now, this most recent reading of July is very close to where we were hovering last summer when we packed a ton of business in just those very few months. Again, context is really important. If we go back to 2019, that's what we look at for true context. It's really hard to look at 2020 because it was such an erratic year and erratic numbers. But this reading back in July of 2019 was much lower. Right now we sit well ahead of where we were back in 2019. Again, context is very important. So, is the housing market cooling off? Go back to July of 2020. 26.8% of homes sold over list price. June, 50%, July, 49%. So we're seeing some of these slight signs of cooling, but 1 out of 2 homes selling over list price certainly is not what I would consider a cooling market. Now, how did we get there? Let's start with new monthly listing counts and go all the way back to 2017, and we have in here 2020 as well. So if you look at 17, 18, 19, kind of follow this curve. Sometime around May, we start to peak in new listings coming to market, and then start to go down and further dip in October, November, and December. That's what an average year looks like for listings. We start out with a bell curve shape, peaking around May, and then starting to tail off. You see on the orange bar what happened in 2020. We started off on that normal pace, and then we dropped down during the lockdown, and then people pulled listings from the market. Once the lockdown was lifted, we started to see these listings come back at record levels. But here's the key that I want you to look at. When listings started to come back to market last year, we never hit the historical number that we saw back in 17, 18, and even 19. We were shy of that. And you can just see it there where we kind of hover there below and then tail off at the end of the year. Folks started putting their homes on the market towards the end of the year, but we never saw the volume or the count coming to market like we had seen in the historical years. Now, let's look at what's happened this year. We're starting to come up, but again, very shy of where we've been historically in our numbers as far as listings. You see the listing rise through the May time frame and then come through June and July kind of flat. If those listings start to fall, then we're going to see more pressure and upward pressure on prices as we already have. If those listings start to climb and get in with what we've seen in the previous historic years, then we should see less robust price appreciation here in the Front Range. If sellers continue to bring back listings, we could see a wave of real estate activity heading into the fall, which is what many are predicting. So all that's going to be dependent on those that put their homes on the market. So let's really break down and talk about housing affordability. This is the average monthly mortgage payment, and it shows how it's increased in the last few months. This goes all the way back to April 2020, where we can see those orange bars kind of humming along. Then in March, April, May, June, that monthly mortgage payment starts to rise. And that is a direct reflection of home price appreciation. You can see that rising mortgage payments is contributing to affordability, and affordability is decreasing. The higher the bar, the more affordable the homes are. in January, it was much more affordable to buy a home than it has been in the last few months. We can see that. We can see also the affordability, how it's continuing to decrease. That is what the data is saying, and it's starting to spark this fear for consumers of all these different consumers who may be sitting on the sidelines watching this and wondering what to do. Here's the Housing Affordability Index from 1990 all the way to today. We can see here that the blue bar over on the right shows that homes simply aren't as affordable as they were even over the past few years. And a lot of times what people think when they say homes aren't as affordable anymore, they think that there's this housing bubble that's going to burst, and that's been the talk as well. Those are the orange bars. Are homes as more affordable as they were back then? No. When distressed properties were dominating the market? No. But as what we look at here at this chart, we can see homes are much more affordable today than they were at any point leading up to the housing crisis. Now, this takes into consideration wages, prices, and mortgage rates. So all those factors combined, we can see that homes are still affordable today. But you're not going to get the deal that your neighbor got and your friends maybe got a few months ago. So that's the price appreciation starting to play into the affordability, which again is affecting all of us. Now, where this becomes a real concern is when we talk about renters who are sitting on the sidelines. So if you've seen this, you've probably seen this graph before. This is the median asking rent, going actually all the way back to 1988. And it's continuing to climb year after year. And it's truly skyrocketing over the past few years. But renting is creating this real long-term financial challenge for those who are waiting and continuing to rent. Here's the other reason renters are on the sidelines. You can see in this red section the percentage of monthly income that it takes to actually purchase a home, and is now climbing even at a faster rate. Currently, it's at 17% of monthly income right now. The historical norm, though, is 21%. So again, context really helps shape this picture for anyone who might be waiting to buy a home. When you look at this graph, you can see mortgage payments as a percentage of income. So that green bar, that's the data of what is saying where we are today. 17% of income is going to a mortgage payment for those that are buying today. Historical average, we're well below that. So that's the orange bar at 21%. And today, we're also, so far, NAR's guidance of saying 25% income can go to a mortgage payment. So when you put all of that context together, and we see in the green bar where we are today at 17%, it feels like it's climbing, and it is. That number's going to go up, and it's not as affordable as it was to buy a home just a few months ago. And it's not as affordable to buy a home as it was during the housing crisis. But when we look at the data going all the way back to 1988, and we put that into perspective, what we know today is that homes are less affordable, but they're not unaffordable. So for those who are renting, and if you can find a home today, purchasing a home is going to create more long-term wealth benefits, especially when we factor in equity and rising rental prices in building that long-term wealth for you and for your family. So are we heading into a more normal market? Let's first talk about mortgage rates. That's what's fueled the demand over the past year. If you start to look at the rates by decade, 70s, 80s, 90s, 8% wasn't considered a very high rate. Today we sit at 2.8% on the average 30-year fixed nationwide. We certainly wouldn't say this is a normal market by historical standards. Next, let's look at home price appreciation by the year. Nationally, we're at 14% appreciation, and you're seeing higher numbers come out of Case-Shiller and others as high as 17%. You see the red bars in the middle are the years we saw depreciation in the market, but the average is the orange bar there in the middle, and that's at 4%. Months of current inventory has been the biggest issue in our housing shortage over the last year. Currently, we sit nationally at 2.6 months of supply on the market, but locally here in the Front Range, we're around 30 days. This goes all the way back to 2011. That's anything but normal, as we need more homes on the market. Now, how long is it going to take to sell a home nationally? 17 days. Going back to March of 2019, we were at 42 and 49 days at some of the peaks. So the number of offers that are made on average on a listing across the country range around a couple of offers on the average listing. But over the last couple weeks, we've seen that even slow down to single offer situations, which again is a sign of easing back into a normal market. Now, looking into home prices going into 2022, the average of these forecasters, looking at all these, is 5.5% appreciation. It's common to hear people want to wait until next year when things cool off just a little bit. Well, if you're going to wait till next year, it's just going to cost you more money. The market is slowing down, but the market's not dropping. With that said, let's break down the numbers here in the Front Range and take a look at where we're sitting currently. In Larimer County, there are currently 616 active listings, 768 homes which sold last month, up by 9% over last month. 35 days on market average sales price, $575,000, 22 days inventory, up 15 from last month, and a total of 815 new listings taken in the month of August. Weld County, 524 active listings, 770 homes sold last month, down by 3% over last month, and 34 days on market average. Average sales price, $470,000, 27 days inventory, up from 15 last month, and a total of 703 listings taken for the month of August. Boulder County, 462 active listings, 530 homes which sold last month, down by 14% over last. 30 days average on the market. Average sales price, $816,000, 27 days on the market, 27 days inventory, up from 21, and 591 new listings taken last month. So whatever your real estate needs are, please rest assured we can help you. We grow our business on relationships, with the consumer experience being the most important thing. I personally would like to thank all of you for the recent referrals and the trust you've put in our team. For all your real estate needs, go to kevinsellsco.com or 720-230-3030, and myself or a member of my team will be ready to assist you and take care of you and your family.